This is the weekly economic and market update for the week ending November 25th, 2022, and I look forward to the week of November 28th. And this week I wanted to start and take a look at these data. Um, you know, People are maybe a little more optimistic than I am about the economy, and I just want to kind of show things. There are some good and bad news this week, so I'm going to show you some things that why I'm so pessimistic about the long run, and you know, a lot of it has almost all of it has to do with the amount of debt that we have. Um, and let's just kind of take a look at the consumer debt that we have. And, you know, if we were to look at the consumer debt back during the great financial crisis, it was what? Around, this is the consumer debt, not the federal debt. So consumer debt was around, I don't know, 12 and a half, $13 trillion, it looks like, somewhere in that range. And today, it's 16 and a half trillion. So that's just one thing, and it keeps going up, the amount of consumer debt that we have. Now, let's take a look at the U.S. Debt that we have, and let's compare it back to 2008. Looks like it might have been around, I don't know, 11, 12 trillion dollars, and today, $31 trillion, and you're paying interest on that. You are the taxpayer, ultimately. And so we're not getting closer to paying anything off. We're spending money in our government like a drunken sailor, and the Fed is trying to raise rates to counteract that, and it's just two things working against each other. So I just wanted to kind of go through and just make the comment that this is why I am so pessimistic about things. It's the spinning plates analogy, right? Where you got all these plates spinning to keep the debt going, and some, and we're not the only country, right? Everybody has this huge amount of debt in their governments because of the pandemic or poor decisions or both. And so the economies, to me, is still very fragile and not very strong, and hasn't been for decades, really. Um, it's a situation where we're not doing the right things, I don't think, as a country. Uh, I'm not going to speak for other countries, but here in the U.S., the amount of spending that we're doing, the lockdowns, it's just insanity. It's like we have this open checkbook, and then, the Fed's doing crazy stuff on their side to try and counteract it and ignoring the cause of it, which is the government spending. So anyway, that I just wanted to open with that comment and look at those two pieces of data. All right, let's take a look at the investor sentiment survey. The bearishness has not changed anything from last week, other than you've got a lot more people that went from being bullish to being neutral. And so, 40.2%, there's still a lot of bearishness out there, not as much as we had. I look for the bearishness to kind of subside here, at least for the next couple weeks, and I'll get into that in my final comments at the end. Let's take a look at the fear and greed index. We've gone still in the greedy zone right now, and it's kind of almost like I don't know. It's like all the investors have fallen asleep because they ate too much turkey or something. But there isn't a lot going to be happening over the next couple of weeks from an economic standpoint. But as far as the reporting goes. But we'll take a look at that, but there's just not a lot of market movers out there. Now, something might crop up, unexpected, some maybe small baby swan, black swan event, or there's always the potential for some type of craziness to happen in Ukraine and Russia, China and Taiwan. I mean, and other things that potentially could happen. But I don't really see a lot that's going to be a market mover, at least on the agenda for right now. So let's take a look at some of the economic data from last week. What's the calendar? And this past week. So durable goods, was up, expected to go up 0.4%, went up 1%. I mean, that's kind of good news, People are still ordering some durable goods. It's not what I would consider strong. We look historically, it's just kind of hanging out. So there's really not a ton to report there. And new home sales. It was actually a little bit more than the consensus. 632,000 units sold. And so that's kind of good news, on the sale front, the home sale front. Let's look at permits, building permits. All right, expected a little over 1.5 million, 1.526 million consensus, 1.512. Nothing to get depressed about, but a little lower than what the consensus is. But it's down from where it's been, and overall we're in a downtrend over the last 5 years. Let's look 10-year. Yeah, we're kind of falling below the trend line here. I wonder if I can do that. There we go. So we've fallen below the trend line, and so that's not good news that it's there, but it's hanging in according to what we think would happen. Let's see, who else do we have here? Let's take a look at the 30-year mortgage. And so that's been kind of a good news type of thing. We see some of the interest rates, the long-term interest rates, heading down on the 30-year, because that has helped kind of keep the housing data afloat. 6.67% the latest mortgage interest rate. But if you can, you can look, it's up definitely, and the optimal time would have been to do it. I think that was in the summer of 2020 or the fall, where interest rates were its lowest. I took advantage of that at that time, and hopefully you did too. I think there will be another opportunity upcoming in the bust, the predicted bust. And let's see if we've got anything else here. Yeah, I mean, FOMC came out and they said basically do a 0.5 point. That kind of gave the market a little boost. That it would be going up only a 0.5 point as opposed to 0.75 point. But that doesn't happen for a couple more weeks. So that's kind of the look at the economic data. Let's take a look at some of the market data. Not that one, this one. And we'll start with the 10-year. It's been on a downtrend. These are weekly data. Oops, not hourly. I've been kind of watching this zone up in here to see it's staying below it. I'm cheering for it to get below the 3.577% and work its way down. But it's, it started up, but that's a nice look at a Japanese candlestick that you like to see the downward trend on that particular candlestick. It went up, came back down. So I look at that as good news, at least for today. And for the week, it was down. And we just got to keep hoping that that thing works its way down under, let's say, 3.5%. We'll look at the DXY, which is the US dollar index. And again, these are things, as long as the 10-year keeps going down and the dollar starts weakening a little bit, well, that's good news and bad news. The good news is that'll drive the market up, but it will make your things even more expensive to buy at the retail stores. And we've got it peaked here at about 100 and almost 115, and now we're back down to 105. Kind of have a doji here that just means there's indecision. Could go up or down from there. Who knows what it's going to do, but obviously if you're wanting the market to go up, then you're going to want that to continue to work its way down from there. And if it goes back up, then we got to start talking about Brent Johnson's milkshake theory again. WTI Crude. Now, oil has continued to go down. Starts getting under 75. We'll get some relief at the pump. Looks like we might have like a quadruple bottom here, which if that is, and that's the thing about technical analysis. There's who knows whether it's going to go up or down from there. I mean, that's all I can really derive from some of the technical analysis. But it's basically saying, it ought to go back up with that many hits. And other people say, nope, with that many hits, it's going to go down with technical analysis. And guess what? There's no statistics on any of it. And the ones that have been run say that technical analysis really doesn't help you. So I use it to a certain degree just to look for entry points on things. The key is managing your risk. And as we get closer to where I think we're going to be having to not have new market highs, you're gonna have to learn how to play this game. You're not going to be able to throw it into a company and let it sit there for years. It's going to take some work in order to make your money grow. Okay, let's take a look at the economic calendar for next week. And there's any of these things could go south that might involve the market's reacting to it positively or negatively, but focus in on the highlights here are going to be at 2:30 on Wednesday when Chairman Powell does a speech. I'm sure he's going to give the markets a beat down during the course of that speech and how tough he is and all those types of things. But I think the next morning at 9:30 when the PCE price index comes out with the core and the PCE, that could either reverse anything he said or whatever. If the PCE index year over year comes in, they're expecting 5.9, even if it comes at 5.9, if last month was 6.2, 5.9% will be something that the markets will react positively to, which gives me kind of a positive sentiment about where the market's going to be going, at least next week. And that anything under 6% would be welcome news. You get anything below 5.9%, and the markets will probably rocket up because we have all these outside influences with the Fed manipulating the market, tampering, as I would call it, tampering with the market. And the Fed's going to follow its measures, its lagging measures, and we'll see what the PCE comes out. If it does come out 5.9%, that would be great. Anything less than 6.2% will probably give the market some fuel to go up. Anything over 6.2%, conversely, is going to make the markets rethink its entire life. So that's my expectation. Those are the things to watch for next week. are the Fed speech, Chairman Powell's speech on Wednesday afternoon, and then the next morning the PCE numbers as they start to come out. So, kind of my final comment, here with regards to it is my expectation is that the market's going to go up. Now, that's not a trading call. That's not anything put a ton of faith in. I've been wrong the last 2 years as far as the timing goes that the market would collapse at some point. And that's still my expectation. And I built that, as I said at the beginning, around the fact that the amount of debt, both consumer and government, U.S. government debt, is going to catch up to them. And I think Powell's made a number of errors here and how he's approached. Well, it's not just Powell. I mentioned many times, he goes back to the great financial crisis and the response to it with quantitative easing, the easing of money, which has driven this thing up really high over the last 14 years with those moves by the Fed. And now they're having to pay the piper. Now, nobody's ever done quantitative tightening before. Nobody's ever, well, I shouldn't say, we've definitely manipulated the federal funds rate, but quantitative tightening is, it's never been done. So we'll see how it plays out if the Fed can come up with some type of soft landing that they keep talking about. But I don't think it's going to be, my expectation is going to be a hard landing. I hope for a soft landing. I hope everything I'm saying is wrong. But I'm giving you the evidence of what I see, and I think people have to go into this, these markets and this economy with your eyes open. So call me the pessimistic one or something like that, Dr. Pessimistic. I don't know. Anyway, that's my expectation in the short term, though, is the markets will go up. The end of this, as I spoke about last week, this 80-year cycle of the turning, and how high it goes, I'm not sure. We'll go to all-time highs, like David Hunter says, maybe. Will it be just a big bear market rally? Maybe. But my expectation is that at some point it'll turn and go down to that 80-90% level that I've talked about for the last couple of years. So that's what I wanted to cover this week. And remember, there is always a better way.